I appreciate you giving me a little bit of time here. First off, I want to just introduce Chris Smith. You are a business attorney. I've utilized you for some of my clients for LLCs, trusts, just kind of helping them structure businesses. So I often find myself having a lot of questions, and I figured, why not just hop on a podcast? You and I can have, a discussion on some of the questions I often have. That way we can have this recorded. I can reference back to it. If anybody else sees this and finds it helpful, awesome. Yeah, it's a win-win for everyone. So maybe we could do more of these in the future if it makes sense, and kind of go from there. So
sounds good.
Cool. So Chris, I wanted to kind of maybe go into LLC questions, maybe title questions, things like that, because that relates to my mortgage business, and kind of keep it in line with, my mortgage world and your expertise and everything. As far as LLCs, obviously you're not going to put a property in an LLC unless it's like an investment property. And I know when it comes to having an investment property, everyone pretty much says your best bet's to use an LLC for those. So maybe you can go in a little more depth of why it's important to hold your property in an LLC, and then we can maybe discuss the caveats of if I refinance and things like that as well.
Right. So you're not going to put like a personal residence into a limited liability company. So then the question is, why would you put an investment property in the LLC, but not your home? And the answer to that, you need to understand how a limited liability company works. And in my mind, I divide the use of an LLC between operations of a business versus a holding company that holds assets or maybe interest in other businesses. And the idea is that when we're putting operations into an LLC, that's considered a dangerous activity. That's where liability can arise. So we're using the LLC as a shield to protect us from the liability of the business. But with a holding situation, what we're doing is we're putting property or assets into the holding entity for the purpose of protecting the assets from ourselves. So the idea would be that, let's say you and I decide to buy an apartment building together. And if you and I just own it as, Chris and Brandon, and let's say I go out and do something to create a liability, that apartment building could be used to satisfy that claim, even though you own part of it. Your fight then would be with me about, well, you owe me money for the apartment building. So what we want to do is protect the apartment building. And when we put it into the limited liability company, we then receive a charging order protection. And what a charging order is it works like a lien. So if I go out and I have let's say a judgment against me for $100,000, and the plaintiff's lawyer looks at the LLC and says, well, Chris owns half of the LLC. That owns an apartment building. We want the apartment building. Well, the charging order says, no, you can't have what the LLC owns. You can't take anything from the LLC because we have to protect the other members. And you can't seize Chris's interest ownership in that LLC because we're not going to force the other members to now be in business with someone they may not want to be in business with. So
Okay.
what we're going to do is give you a charging order.
Hmm.
What the charging order does is it's an order to the LLC that any distributions that would go to me now has to go to the plaintiff until that judgment has been satisfied. So it's a way for us to protect the apartment from bad acts or debts or obligations that one of the members may incur in the future.
And would that work the other way around? Let's say something happens, somebody trips and falls in the apartment building, sues the LLC. Are they just suing the LLC, or are they going to sue the members of the LLC? And can they sue the members of the LLC?
You can sue anybody at any time for anything. So that, yeah,
Okay.
they could sue the members.
Okay.
You would probably not be successful in doing that unless you can do what's called pierce the corporate veil. Now, the other, this also then leads into a structuring, question is how do you want to structure this? I don't like putting operations. You can't mix operations in holding. It just doesn't work. So what you want to do is put safe assets into the LLC to protect them, which is what we're doing with the apartment building. I would form a separate entity as a management company. And then the management company would serve it as, the property manager or the management solution.
So
And they're the ones who are going to bear the brunt.
if you're not hiring an external management company and you want to kind of manage it yourself, you create a business that's a property management,
Right.
and then that business manages the property, and you may hire some people for that.
Right. And, probably going to manage more than one property, but kind of the way it would work is I would set up a holding company. It would be a limited liability company. And let's say you and I are the two investors, and we would elect partnership taxation so that we have a nice pass-through entity that we're going to be able to benefit from the depreciation deductions, and it's just a preferred way of managing that real property holding. Then there'd be a separate company which would handle the management, probably take an S corporation tax election because we're going to pay salaries and we want to save some money on the employment taxes. But we would run all of the operations through the operating company. So the operating company would go out to the individual tenants, handle vacancies, collect the rent, make sure lease agreements get signed, all the things that you do in managing a piece of real estate. So if someone then slips and falls on the property, your first line of defense is going to be an insurance policy. And the reason you want to have insurance beyond just paying a settlement is they will also pay for the attorney fees, which can be rather expensive. And so the tenant will probably never even know who actually owns the property unless they do a title search, which they can do, and most plaintiffs' lawyers will be able to do it. But the idea is that we're not trying to protect the property from the property's own liabilities. We're trying to protect the property from yours or mine.
That makes
And
sense.
and that's where the LLC comes in.
Now, what if I wanted to buy, let's say, a residential property instead of a big apartment building? Let's say I'm kind of starting out, I'm a new investor, starting out with a residential 1 unit. Would I set up one LLC for just that 1 unit? And then if I buy a second property, set up a new LLC, so each property is in its own LLC? Or would you set up one LLC and then put both those properties in the LLC? How does that work?
So that's a risk tolerance question, the answer is it depends on how much risk you're willing to tolerate. The way I look at it is I don't look at the number of properties, I look at the amount of cash flow.
Okay.
So the idea is, let's say you have to bankrupt an LLC and they successfully attach the properties and they're able to claim whatever's in that LLC. So let's say you have two rental properties generating $5,000 of income every month. And if that LLC is breached, you're going to lose your 10,000 of monthly income. You're not going to have anything coming in after that. If you use two LLCs and one is breached, you're going to lose half of your monthly income. Right. So the question is how much cash flow are you willing to part with?
Yeah.
And so that depends on the individual investor. It depends on how many properties they own. If you own 10 properties, maybe you decided we'll put two in each LLC. That way we're a little bit more efficient, that we don't have to pay, a $800 fee to the California Franchise Tax Board for 10 LLCs. We can just do 5. It's also a number of tax returns. It's the administrative and tax expense of having multiple entities. So you balance.
Now, would I open the LLC? Let's say I want to buy an investment property in Texas. Would I open a Texas LLC versus a California LLC? Like, how does that?
So most often, and there are exceptions to this, but most often I recommend opening the LLC, forming it in the jurisdiction where you're going to do business or where you live. So let's say you're a California resident and you're going to buy property in Texas. So the problem you have is you're doing business in California because by virtue of living here.
Okay.
So you're going to have to probably file a tax return with California, if you use a tax entity, have it registered as a foreign entity in California. California's pretty aggressive about that. It's not easy to get around. I have people who come to me and say, I want to form the LLC in Wyoming or Nevada, but they're doing business in California. And they say, well, I want privacy. Usually by the time we finish the conversation, they agree, well, no, let's just do California, because that's the home state and that's where it makes the most sense.
People still want to do Wyoming corporations after everything that happened with Tesla.
With Tesla, that was Delaware.
Oh, it was Delaware. Okay.
Yeah. So, that was interesting because Delaware is favored for larger corporations because it's a corporate friendly jurisdiction most of the time. But now they're interfering with the compensation package that Elon Musk wants. The judge says, no, you're not worth that. So now you have a judge that's interfering with the operations of a business entity. We'll see how that plays out in the future. We're dealing with the same
other conversation.
Yeah, we're dealing with the same stuff in New York now. A lot of real estate investors and business people are questioning whether New York is a jurisdiction that they want to be in. I think there is for the small investor, the individuals such as you or me. Delaware to me doesn't make a lot of sense.
Gotcha.
I like Wyoming.
It's Wyoming that has the privacy.
Right. So
okay.
So with privacy, you might want that, for example, if you're buying an apartment building, because you don't necessarily want everyone to know that you're an owner of the LLC that owns the apartment building, because now you're a target. On the other hand, if let's say you're a mortgage business, I would not recommend Wyoming, because why would you want to be private in your ownership of K and B Capital?
Yeah.
You want to be exactly the opposite. You want to promote yourself. You want to, have everyone's attention on you and K and B, and you're not going to try to hide that fact. So that makes no sense to have a quotes private LLC when what you really want to be doing is telling everybody and their brother that, hey, I've got a mortgage business and I want to refinance the property for you.
Yeah. Gotcha. Yeah. Mortgage business is an S corp, not an LLC. So that's
Well,
a different structure. But
well, here's the thing: is people confuse the entity versus the tax status. S corporation is a tax status. So what K and B may be is a general stock corporation.
correct. Yes.
Nothing wrong with that.
Mhm.
And sometimes we set up corporations instead of LLCs. The nice thing about the LLC is it's much more flexible. So for example, with the tax status, if someone comes to me and says, I want to start a business. Okay, that's great. We can use an LLC. You get started by yourself, or maybe you have a partner. We'll just elect, if it's by yourself, you can do a disregarded entity,
Mhm.
which means you don't even have to file an IRS tax return
Oh,
for the
really?
business. You just report it on your personal return.
You mean oh, wait, you mean if it's not really making money, or even if it is making money, you just
Yeah, most businesses that get started, you don't make money first year or two, or
Oh,
you don't make a lot.
yeah.
So there's not a lot of tax savings available, when you take the S corporation election. So, most of the time we just started out as a disregarded entity or as a partnership if there's more than one member. And then later, when the money's coming in, now maybe it makes sense to take a look at the S corp tax status. And so then what we do is usually sit down with the CPA, run the numbers, see if it makes sense to change your tax status. And it's it's a form, an IRS form that you fax to the IRS, and you ask them, dear IRS, please tax us as an S corporation going forward.
Mm.
And there's some rules about making the election, but when you first get started, unless you have existing cash flow, I typically just suggest let's keep it simple at the beginning. And if you're going to do a disregarded entity, you don't have to pay your CPA to do a personal return and a business return. It's just a personal return.
So let me ask you this, let's switch gears back into real estate, because I have some clients, actually you referred me those clients even, that I have in mind right now. They have several properties. They're all in LLCs, they're investment properties, residential, not maybe 2 units, 3 units max. And in LLCs, they're doing their taxes in the LLCs. Normally, when I'm doing a loan for somebody, I'm looking at their Schedule K and looking at the rentals that way. But since now it's an LLC, it looks like a separate business, which actually makes it a little more challenging to do the loan and figure out how to structure it, how much income the banks are going to give us. On averaging that out over a couple of years, especially since it's a brand new property. Now, could they technically, and I know you're not a CPA, but I think you know most of how this works, can they technically file those instead of doing an LLC tax return? What is that? I forget what those are.
Well, again, we go back to the tax status.
Yeah.
So if the LLC has more than one member, the default is partnership taxation.
And they are
Yeah.
several members on those.
Right.
So then why it's done like
so
an LLC tax return.
Right. So your CPA is going to then prepare a partnership return for the LLC.
Mhm.
And the profit or loss is then reported on K1 that is issued to the individual members.
Gotcha.
So on the members'
Correct.
personal return, they'll attach the K1 reporting whatever profit or loss was experienced.
Okay.
So, yeah, yeah, as far as, how are you going to do that financing? It's going to depend on the individual lender. You know this better than me. But individual lender and whether the loan is being made to the LLC or whether the individual members are going to use their own personal credit to obtain a loan.
Yeah.
So if it's to
Well,
the LLC, my expectation is they'd want the lender wants a copy of the partnership return so
correct.
that they can see how much revenue is going through, what the profit and loss looks like,
Yeah.
and make a judgment as to whether the loan is a suitable loan for them.
Yeah, and some lenders look at it more strict than others. Some are gonna,
Sure.
give me more income for that LLC than maybe a more conservative lender will. So, all right. So a lot of times, in the residential world, we're not really closing. We can't really close in an LLC unless maybe we're doing what's called a DSCR, debt service coverage loan. But a lot of these, a lot of my clients end up buying, they'll actually give me their income, we'll qualify them on the income, and obviously use a little bit of the rents to offset that as well. But that's, your standard investment conventional loan. They're not going to close in an LLC. So then after we close, they have to transfer it in an LLC. And I know a lot of
Right.
people's concerns are the mortgages have or the banks have a due on sale clause, or if you transfer title, are they going to call that note due now? Like,
Right.
enlighten me a little bit more on that and how that works. And
So when you transfer an LLC, I'm pretty sure all loans have a due on sale clause. But the reality is, I've never seen a bank call the loan.
I haven't either.
And so it's a risk. Yes, you want to let the client know, hey, this is what could happen, but
Mhm.
literally they just made the loan. They're not going to want to call it.
Yeah, it's the
And
kind of the last thing they'd want to do.
you probably tell the lender, hey, look, we want it in the LLC, and if we close outside of a limited liability company, we're going to transfer it in.
Mhm.
And so they probably know it anyway.
Yeah,
But I know that residential lenders they're slow to do that. When you get into larger properties, you're working with different lenders, and also you're probably not working with a small number of investors. You might have a syndicate where maybe there's 10, 20, 30, 100 investors. You're not going to take title in 100 people's individual
no.
names, right?
Yeah,
It's
well, and
not
that's,
going to happen.
commercial's a whole different world where
Right.
they'll close in LLCs all day long. Even, my strict residential investment loans that are, like I said, a DSCR loan, they usually have no problem closing in an LLC. So those are more like a residential commercial loan is what they are, because they're not even using the borrower's income at all. They're just
Right.
making, does the rent surpass or equal to the mortgage payment, taxes, and insurance?
Yeah.
And
And
does the lender.
my guess is that hesitancy by residential lenders, if they're using the individual's income to qualify the loan, they probably want recourse in case there's a default on a loan, and they want to be able to go after the individual.
Just
Uh,
gives them a little bit more ammunition if anything does happen, kind of thing.
right.
That makes sense. Now, what
Yeah.
about, I had another attorney the other day told me, we were gonna transfer the property into a trust after we close, because the bank I was using, for some reason, I'm not gonna say their name, but they wouldn't close in the trust. And then the attorney involved, because it was a Florida deal, he basically said that, well, that could trigger the due on sale clause by putting it in a trust. I was curious if that's accurate or not. It's just something I haven't really heard of. I've never heard of a trust, because
Yeah.
technically
So,
you're not really changing title, are you?
well, there's the Garden St. Germain Act.
Okay.
and which applies universally across the country. And it gives you the ability to transfer any real estate you own into your trust without triggering due on sale clause. So
Okay.
I don't know, what this other attorney was saying, but we transfer homes into trusts routinely.
Yeah, and honestly, I wanted to tell him he was incorrect, but I couldn't use the attorney. I'm just a stupid mortgage guy.
Right.
What do I know? So,
Yeah, no, there's federal law that says, no, the bank cannot call the loan because you put it in your trust.
yeah, okay, that makes sense. And maybe he was just being extra precautious or what have you, and just,
Yeah, if you're transferring it into a trust that maybe it's not your trust, maybe I don't know. You could probably come up with scenarios, but generally the most common scenario we have is someone has a living trust. The reason they have a living trust is they want to avoid probate. They want to maintain privacy. The trust only works on property that the trust owns. So we would typically put the primary residence into the trust. There's federal law that prohibits the bank from calling the loan.
so let's ask this question. If I have a property in a trust, does that protect my property? Like, let's say I do something stupid and somebody sues me. Can they go after my property, or does that is it protected since my property is now in a trust? How does that work?
Generally, no, because typically what we're talking about is a living trust.
Mm-hmm.
But there are asset protection trusts. And depending on where the property is located, and you may be able to use a trust to protect the property.
I see. Okay. So it's a different kind of trust. Now, when I put my property in a trust, I'm going to use a revocable trust, correct? And then
Right.
something called a non-revocable trust, which is usually after somebody passes, I believe, correct me if I'm wrong on this. Somebody
Right.
passes and now let's say my grandma passed away, I now have her trust. I can't touch it, I can't change it, I can't move anything. So it's a non-revocable, is that correct?
Right. So there's two types of trust: revocable and irrevocable.
Irrevocable.
The revocable trust typically becomes an irrevocable trust upon the death of the grantor. So if your grandma formed a trust, she's the grantor, she dies, it becomes an irrevocable trust. Now, some states, California is one of them, we have what we call the decanting statute. And what a decanting statute is the idea is that you can amend the trust even if it's irrevocable. So the reason we call it a decanting statute is, like, if you're a wine enthusiast and you buy an old bottle of wine, you may want to decant the old bottle of wine into a new container to get rid of all this sediment and the things that you don't want, ending up in your mouth. So the idea with a decanting statute is we're going to take the assets that are contained in this old dusty trust, and we're going to move them into a new trust. And the reason states started adopting this language is that, trusts can go on for quite a while, and some are drafted better than others. But even if it's a well-drafted trust, you can't always anticipate circumstances, in the future, because, people get born and die, and, life goes on, and changes occur. And that old trust may no longer be serving the intended purpose. And so some states have adopted this decanting concept, where under certain circumstances you can update the trust. California is not a great decanting jurisdiction, but they do have language there that that it helps us if we need to.
Okay. That makes sense. Cool. All right, let's switch back to LLCs again. Um, let's say I have a client has a property in an LLC. I have to remove it from the LLC to do a refinance, which is common. And then we close and their names, put it back into the LLC after close. Are there any
Right.
tax consequences to doing that, or is there any issues that you would see to doing that?
So if the property's in California, the issue that I always worry about is a property tax reassessment.
Mm-hmm.
So let's say it's a rental property that they've owned for, let's say 15, 20 years and has seen a meaningful amount of appreciation since the time they purchased it. What we don't want to see happen is to have the property reassessed for property tax purposes, because that's going to increase the property tax bill.
Now, would it get reassessed just by refinancing it or no? Not usually.
Not by refinancing it, but the transfer out of and into the LLC is where the concern is. So what the tax
Even if,
assessment,
sorry, even if there's no name changes, let's say there's two people, Chris and Brandon on this LLC, we transfer it back to Chris and Brandon, still same owners as the LLC, and then we transfer it back into LLC that Chris
right?
and Brandon
And well,
own.
that's the way you want to do it, and you want to
Yeah.
make sure that the preliminary change of ownership report that gets filed with each transfer reflects that it's not subject to reassessment because the transfer is in proportionate interests.
Okay,
So let's say Chris and Brandon each own half the LLC. When we transfer out, we want to make sure that the deed transferring it out says Chris and Brandon, you both have, a 1/2 interest. Now,
yeah,
let's say you own 2/3 of the LLC and I own 1/3. Well, we want to make sure that that's reflected on the deed and on the preliminary change of ownership report. And then when it goes back into the LLC, we want to maintain that same proportionate share. As
okay,
long as we do that, we're safe.
okay. But you just can't be sloppy when you do the transfers of title and stuff, okay?
Right.
All
And
right.
and I'm not aware of any kind of income tax, liability that would arise from that.
So is
Um,
that something you would be involved with if I said, hey, I got this client that has a property in LLC and we have to transfer it out, or does you usually escrow just handle that for me?
but my experience is that that's something escrow does.
Yeah,
It's, there, I've never been asked by escrow to handle a transfer. They just do it.
exactly, yeah.
Yeah.
My experience, okay. Just wanted to confirm.
Yeah, usually where I get involved is someone does a refinance. Their property used to be in their trust, now it's not.
Yeah, I was gonna say at the tail end, that's probably where you have to get involved. and
Yeah, so
Put
then
it
I'll,
back into the LLC because escrow's not gonna put it into the LLC. I've had them actually take it out, but never back
and
in.
then they don't put it back.
Yes,
So one of the things we do with our clients that we've done estate plans with is we do an annual review,
okay,
and I have a access to a service where I can just type in a property address and see how it's titled. And so it's just a part of a routine check that when we go through someone's plan to make sure it's still current and whether it needs to be changed, we look to see if the property is still in the trust. And sometimes it is, sometimes it's not. And
trust or LLC or
yeah,
whatever.
and when it's not in there, it's usually either because they refinanced the property at some point after we did the estate plan, or for whatever reason they just never got the property transferred, which happens sometimes. So when you have an estate plan done and you work with a lawyer on an ongoing basis, one of the things you want to see happen is let's check to make sure everything on the asset schedule is where it needs to be. And so we maintain an asset schedule for each client, which not only includes real estate, but bank accounts and investment accounts and and those change, so you want to review it periodically. We encourage once a year. But yeah, you always want to check your real estate holdings and make sure they're properly titled where you want them to be.
Makes sense. Cool. Okay. I think you answered most of my questions on LLCs. Is there anything else you'd want to bring up that maybe I didn't address?
Well, probably the one thing, we can touch on is the idea of working with someone who really understands how an LLC works.
True. Yes.
I would never recommend owning real estate in a corporation, for example. It's because corporations, you only can choose one of two tax status. It's a corporate tax status, either S corporation or C corporation. And this would be a great podcast for us to pull in a CPA and talk about why you don't want to own real estate in a corporate entity. With the LLC, we can, tax it as a partnership and take advantage of a lot of the benefits that partnership taxation offers in that context. So when you start going down this path, it's very easy to form an LLC. You could do it yourself. You can pay a LegalZoom to do it. But what you do after you file that piece of paper with the Secretary of State starts making a big difference. And this is where you want to be working with not just a lawyer, but you want to be working with a tax advisor. You also want to bring in your insurance professional. You don't want to just buy a policy from, say, Allstate or State Farm. You want to work with someone who's, an experienced commercial broker on investment properties, because that's going to be your first line of defense.
Okay.
And you put that team together, and they're going to be able to help advise you and have conversations about, for example, how many pieces of property should we have in one LLC? Should we use a California entity or some other jurisdiction? When these things start making sense, you can rely on that team to make sure that the whole thing works together. The biggest mistakes I've seen, or the biggest negative outcomes I've seen, are when people have tried to do this themselves because they read something on the internet, or they went to a seminar and heard something on the weekend, that this is how you're supposed to do it. And the worst outcome I've seen is, not only did the investor lose the property, they opened themselves up to personal liability that was unlimited, and there was no insurance for it. So not only did they lose their real estate, they lost a lot of their investment, personal holdings. Their own home was put at risk. It was a worst case financial disaster, and it's because they wanted to, quote, save money and do the structuring themselves.
Makes sense for sure. You always have to have a team of professionals by your side when you're growing and you're doing things bigger than you used to do them. So
yeah, well, you're dealing with property that's probably, you're probably putting $1 million or more at play in these investments, and you don't want to put assets like that at risk over a few $1,000 in fees. You want to work with the tax advisor. You want to make sure your tax returns are handled properly. You
Mhm.
don't want to have to, deal with an IRS audit. And if you do have to deal with an IRS audit, you want that CPA there to, handle it for you, because you do not want to talk to the ladies and gentlemen at the IRS.
Yeah, for sure. Well, awesome, man. I really appreciate your time. I know you're a busy guy, and yeah, I want to thank you for giving me a good 40 minutes or so and making this happen. So next time, maybe next week we can start doing this a little more regularly. And I'd definitely like to talk about different ways of holding title as individuals and stuff for my industry, for when you're just buying residential properties versus just investment things. So maybe we can dive a little deeper into that too, and what the advantages, disadvantages to, joint property, community property, things like that. So yeah, I guess we will call this one and not make it overly long, and we'll do another one soon.
Perfect. All
Cool.
right, man.
All right, let's pause.